Hello everyone, I welcome you to another amazing episode of the Forex Beginners course. And here we have basic technical analysis. Before, when I was talking about analysis in general, I said we have two types. We have fundamental analysis and we also have technical analysis. And I said fundamental analysis are mostly based on economic, political, and news events, but technical analysis is what we are going to be using the most because technical analysis it involves using past price action to predict future price movements. It means something that price has already done before. So what happened after it? So it is what we are now going to be using to predict the future price movement of the markets. So that is basic technical analysis. Now let's get into it. So phases of the market. I need you to know that the market has two major phases, the impulsive phase and the corrective phase. So the impulsive phase is where there is enough momentum in the market, and the corrective phase is where the market is, let me say, consolidating before another impulsive phase. So these are the two major phases of the market that we have. The impulsive phase, which is where the momentum kicks in, and the corrective phase, which is where the market is correcting or consolidating and waiting for another impulsive movement. So the market is mostly in a state of correction, but our aim is to time our entry and catch the impulse just before it happens. This is simply a way of explaining what an entry is. So, I already said there are two market phases, impulse and correction. So, the market is mostly always in a state of correction. It is always correcting. So, our aim is now to time our entry and catch it just before the impulse happens because the impulse is exactly what we are targeting. It's exactly where we are trying to catch the pips, where we are trying to make our money. So, that is why we are trying to catch the impulse. So, I'm trying to show you how it looks like on the chart. So this long one is the impulse, and this is the correction, then another small impulse, then correction, impulse, correction, impulse, correction. So let me show you this on a chart. So I have labeled it here, as you can see. So this is a strong impulse, as I've labeled it, then a correction or consolidation, as you wish, then another impulse downwards, then another correction, then impulse downward again, then another correction, then an impulse, then a correction, then another impulse downward. So you can see them now, and as I've already labeled them. So what I also wanted to know is that the correction might not be as neat as I've drawn them here. So the markets can be ugly at times, and I've said that before. So it is not always rosy. So, but I'm going to be showing you different type of corrections that we have and how you can spot them and time your entries. So, but I'm just showing you this so you can have an idea of what I'm talking about. So, the market is always in the state of impulse or correction. So, if it is not impulsing, then it is correcting. So that is it. So let me show you on a live chart. So if you look at this pair also, this is USD card. You can see the market here. This is a very large impulse, then a big correction, then another impulse, then this is another correction. Let me show you. You can call this another correction. Yes, this is another correction. Impulse, correction, then another impulse downward. So that is the state of the market. That is how the market moves. It is either in the state of impulse or in the state of correction. Like I've labeled here also, this is a strong impulse and then a strong correction. So if we dive deeper, you can see that inside this correction, there is another impulse, correction, then another impulse. Let me label them. This is an impulse. This is a correction. Then this is another impulse. I hope you are getting it now. You can see from the outer structure I showed you earlier, this is an impulse, then there's a correction, then there's an impulse. Because this is the higher time frame, weekly time frame. So if we go to the daily time frame, which is a lower time frame compared to the weekly time frame, you will see that inside the weekly correction, there is another impulse, correction, and impulse. What I'm trying to make you understand here is that if you go to the higher time frame, even a correction there are always plenty moves that you can catch on a time frame that is lower than that particular time frame. I hope you are getting it now. It means even in this daily time frame, if I go lower and I go to the 4 hour time frame, you are still going to see some impulse, correction, and impulse inside this correction of the daily time frame. Here, I already circled it. Yeah, in this correction, if we go to the 4 hour time frame, you are still going to see some impulse, correction, and impulse. If you go there on the 4 hour time frame also and the correction there, we are going to see some impulse, correction, impulse too if we go to the 1 hour time frame. So that is how it goes till we reach the lowest time frame. I hope you are getting it now. So this is telling us that the market is always in a state of impulse and correction, no matter the time frame you are on. So what I want you to do now is when you are done with this video, just go on the chart and go to as many pairs as you like and mark out the impulse state, the impulsive phase, the corrective phase, and then the continuation of the impulse. So mark it out because how you are going to grab this is if you see it yourself, if you spot them yourself, then it is going to stick. So I want you to do that. Now let's continue. So we have explained the impulse, correction, and impulse. So one other thing I also want you to know is how we how we enter trades, how we set profit, how we set our stop loss, and how we set our profit target. So let me use something as an example. Okay, let me use, for example, in this impulse correction and impulse, this is trending downward. This is a downward impulse and then there's a correction, then there's another movement downward. Let's say you are trying to catch the impulse downward. You know, I told you that when there's a correction, then what we are looking to catch is the next impulsive phase. So now, since the correction is about to end, if you are trying to catch the next impulsive phase downward, then it means you want to short this pair, you want to sell it. So let us pick our sell to, you know, when I say short, this is short position, it means sell position. If you want to sell, then you are going to use these two. Then you can place it just under this correction, and then the stop loss will be above, just above it. It means it is protected. So then your take profit will be like this. So this region is your stop loss, and this region is your take profit. You can extend it for as long as you want, depends on what you are looking for. So you can also time your entry inside here, since we have another correction inside. So your entry can be inside here and your stop loss will be above here, just above the correction. So that is it. So you might be wondering what is take profit, what is stop loss. Take profit is your target where you are targeting your price to reach in on the chart. For example, this is the beginning of the correction. So let's say when you are trying to sell this pair, you are trying to sell it back to this point. So it means this point is your take profit. So your stop loss is like an invalidation area. It means an area where if price hits it, then it will take you out of the market. It means you have lost that particular trade. So that is why you must make sure that whenever you are entering a trade, your stop loss is protected. You must put it above a particular structure or a particular correction. So you don't put it in the middle of a correction like this. So it has to be above it. Then that is when you are sure, oh, okay, this stop loss is protected. So that is that on that. I hope you now know how to set stop loss and take profits. If you also want to long, let me show you how to place it in the reverse. Let me flip the chart. Yeah, let's say you are trying to long this pair. You know, this is impulse upward, then correction, then impulse. So you can see the stop loss is also the stop, this red area is the stop loss area. So if you are trying to long this pair, meaning if you are trying to buy it, then your take profit area can be around here, and then your stop loss can be above this correction. I hope you can see. Then your stop loss can be above that correction. Then that is when you know, okay, your stop loss is protected. Like I've said before, stop loss is like an invalidation area in which if price hits it, then you will be taken out of the market, out of that trade. And your take profit is an area where your your broker will take you out if price hits it in profit. This time in stop loss, you'll be taken out in loss. In take profit, you'll be taking out in profit. So that is the difference between both of them. And usually your stop loss has to be smaller than your take profit, because in take profit you have to make sure that you are targeting a particular area, and in your stop loss you have to make sure that your stop loss is not too wide. And this is just because I'm showing you an example. You have no business catching a trade on the daily time frame. Your entry time frame are mostly 1 hour time frame, 15 minutes time frame, and 5 minutes time frame. Those are the time frame we are going to be entering the market from. So you are not going to be entering the market on a weekly, daily, or 4 hour time frame. I'm only using this as an example. So I hope you get it. Now I want to assume you now know how to set take profit, how to set stop loss. So let's us move on. Now, types of entries. There are various types of entries that you can use in the financial market, and I'm going to be taking you through some basic ones that won't be very difficult for you to understand. So this is one type of entry. You can see, like I've said before, if you remember, this is an ascending channel. So if you see an ascending channel like this that has three touches, this is first touch, second touch, and third touch. And then it impulses down a bit and then creates a correction. Then you can catch the next impulse by placing your entry just under the correction, and your stop loss will be above the correction. I hope you are getting it now. So your take profit can be at where the correction started. That is where you can place your take profit. But your stop loss has to be above the correction. So you will make sure that your stop loss is protected. So that is entry type number one. Number two, this is also an ascending channel, but you are going to notice one difference with this one and the first one I showed you. In this first one, market price got to the particular area in an impulsive manner and then came back down in the same impulsive manner. But here, price got here in a bit of structure. You know, this is an ascending channel. Then in that ascending channel, there is another small ascending channel. This is what we call pattern in pattern. So if you see a pattern like this, then it has a high probability of playing out. So you can set your entry at the top of that structure. When you see a rejection candle, remember under the candlestick, I taught you about some candlesticks that you are going to be using at some particular area. This is the type of area I'm talking about. The type of area where market is meant to reverse. So you know this is first touch, second touch, and third touch. After the third touch, you are expecting a reversal. Then there's another small structure inside here. So it means there's a high probability that this will play out. So if you see maybe a doji candle and maybe if you see an evening star or a 1 hour retrace or an eye test candle here, those are rejection candle. Then you can enter after the closure of those candles and set your take profits at the lower place. Then your stop loss will also be above the structure. Now another entry type. This other entry type, in case you miss the first entry, this is very similar to the one I showed you just now, but the difference is that the entry is at this area, at a lower area here. So this is in case you miss the first entry here. Then if you see a correction at a particular area down here, just before it breaks out, then you can set your entry below the correction and then your stop loss will be above the correction and then you set your take profits at the beginning of the correction. I hope you are getting it now. So I purposely uploaded these images so it will be easier for you to check later. Let's go to the next one. So this is in case you want to long the pair or you want to buy the pair. If you see a descending channel like this, you can see this is different from the previous ones I've been showing you. So if you see a descending channel like this, then and you see an impulsive movement upward and you see a correction, then you can enter after that correction, then catch it to the upside. Let's go to the next one. So this is basically a double bottom. So you know I told you about double bottom before also that it is mostly when you say double bottom then a reversal mostly always occur. So this is a double bottom, then there is a sharp reversal to the upside, then there is a correction. So when you see a setup like this, then you can catch it to the upside. After the break of that correction, you set your buy order after the break of the correction and set your stop loss below uh, the correction. So let's go to the next one. This is for short order or sell order. When you see a double top like this, then price comes back to tap that top and then reverses and creates a correction. Then you can enter after that correction. So this is the next one. This is a structural approach like the one I showed you earlier before, if you remember. So there's a double bottom and then there's a structural approach to the double bottom. And then as price it breaks it in a structural manner. We can enter this with a risk entry. Risk entry means entering at the edge of structure. So when you enter this type of how to enter this type of setup is placing your stop your entry order after a rejection candle. So it means when the structure here it has three touches, one here, 1, 2, 3. So at the third touch, if you see a rejection candle to the upside, then you can enter, and then your stop loss will be below the structure. Then your take profit, you can set it at the next structural high. So let's go to the next one. So this is also the next one. In case it is you want to sell or you want to short, so you will see a double top like this, then you can take a risk entry. So like I said before, risk entry is just catching a trade at the top. And like I said before, uh, the reason why some of these peers are breaking this high is what we call mass psychology. I'm going to explain mass psychology at the end of this section. So, but follow me. So, you can enter with a risk entry here too. This is another type of entry. So it is a structural entry also. You can, but in case you miss the first entry, so if there's an impulse upward and there's a correction, you can always enter also after the break of the correction. You set your order at the top and then place your stop loss below it, and then you set your take profit above it. So you can see that those stop loss, they are not usually very wide, and take profit is usually wider than the stop loss. So let's go to the next one. So here, after the structural approach, if price impulses downward, you can also catch the next trade. If there's a correction that is a bit large, then you can catch it at the top of the third touch when you see a rejection candle. I'm going to be showing you all this on a live chat. So, but these are just images for you to understand what I'm saying. So you can always catch a setup like this too. So the next one, this is also the next one. This is an ascending channel that meets with a double top. So this type of setup is a high probability setup. You can catch it from the top here at the edge of structure. But in case you don't catch it, you can allow the trade to impulse downward and create a correction. Then during the correction, if you see a mini double top, you can always place your entry when you see a rejection candle, and then your stop loss will be placed above the double top. Then your take profit will be put downwards. So that is all for the types of entries we have. So in the next section, I'm going to be showing you on the live chat how you can take these trades and exit them. Thank you.